Welcome back to More Fun with Finance. I'm Dr. William Elliott, coming to you from beautiful uptown Shaker Heights. A little bit damp today, but that's all right. We need the rain. So today I would like to get started on Chapter 6. A lot of what we're going to be working through in Chapter 6 is an example. And I'm going to walk you through the example itself, and then I've got a spreadsheet that I'll also, by the way, I'll be sharing that spreadsheet on Canvas with you, but I'll use the spreadsheet to help demonstrate how to work through this example and come up with all the correct cash flows and put them all together and ultimately do a discounted cash flow model and come up with a net present value. So let's get started here. Let me get the slides here. I'll get out of the way. So we're going to talk about what cash flows are important, what cash flows, all cash flows are important, but what cash flows are used and how do we arrive at them from accounting numbers. So mind you, accounting numbers and cash flows can be different things. So you look at an income statement, for instance, net income. Net income is not a cash flow. It's not a cash flow because it includes non-cash expenses. So things like depreciation and amortization are in the income statement, right? You subtract off depreciation, and then you subtract off interest, and then you subtract off taxes, etc. But depreciation is not an actual cash expense. It's a fictional thing. It's a non-cash expense. The accountants have created this thing called depreciation to try to recognize the fact that the use of a particular asset may be spread over a period of time. Whereas in finance, what really matters is cash on the barrelhead. We may have all the deductions that we want, but if we don't have cash flows, if we don't have actual dollars flowing through the firm, we don't have anything. So we're going to define those. Then we're going to introduce the Baldwin example, and we'll walk through that. And that example is going to be one of the best ways to have you really understand how to calculate these cash flows, because we've got things like salvage value, we've got to come up with an operating cash flow, a couple of different ways you can approach the operating cash flow, things of that nature. But don't worry about it if this is kind of gobbledygook at this point. Okay, so we're going to be talking about incremental cash flows here. And first off, as I just said a minute ago, cash flows matter. Accounting numbers don't. It's not that they don't matter at all, it's just that we're not going to be able to use them in the same way that others may attempt to look at net income. For instance, net income itself, right? Net income is not a cash flow. It's not a cash flow because, well, it's got things like depreciation, amortization. Those are non-cash expenses that reduce our net income, but they also reduce our tax burden. Now, the tax burden is a cash flow. That part we need to recognize. The depreciation itself, not a cash flow. So we need to add that back in. So it's not as though the accounting statements are wrong. I mean, there's a lot of sense to what the accountants do. The reason that we have things like depreciation is that we have assets with lives that are 2, 3, 4, 5, 10 years long. And they are trying to recognize the fact that those assets have that long a life, and so they spread the cost of that asset over that particular period of time. But that's not what we're dealing with. We can't really deal with that because there was no transaction. So we have nothing to actually take a present value of. It's just a fiction. All right, so it's got to be a cash flow. It's got to be dollars flowing from one hand to the other, either a cash inflow or a cash outflow. Sunk costs also do not matter. In other words, if I've done a preliminary study on a particular project and I spent $1 million on that, and now I'm trying to determine, should I do this project? I'm doing my due diligence and coming up with a capital budget for the project. That $1 million doesn't show up anywhere in there because I've already spent it. You've heard the old adage, don't throw good money after bad. That's the idea that sunk costs don't matter. Just because I spent $1 million doesn't mean I should spend another $10 million to take on a project if it turns out to be a negative NPV project. All right, so sunk costs do not matter. Incremental cash flows, on the other hand, do matter. That is something that we can use. It will take a little adjustment to get those numbers from the accounting statements, but it can be done. Now, if you're just doing a project, you don't have to worry about that. Now, you still have to worry about estimating those cash flows, but it's not as much of a problem when you're just doing a project for a company. Opportunity costs matter. Say I've got a piece of equipment that I can sell for $10,000, but hey, this new project that I'm undertaking, I could use that piece of equipment in the new project. How do I account for the value of that piece of equipment? Well, if I could have sold it for $10,000 after tax, that comes into my analysis. So opportunity costs matter. Then we have things such as synergy and erosion, or what some people might call it cannibalization. So synergy is a situation where a new product may help to sell more of an existing product. They're complements, possibly. So that new product needs the existing product. So as I have more sales of the new product, that drives more sales for the existing product. Well, those additional sales for the existing product come into our analysis. So those we're going to need. Erosion is the reverse of that. Erosion is my new product actually replaces some of the demand for my existing product. Pardon me. And in that case, I have to account for those losses as well. So I account for both synergies and erosion or cannibalization if those occur. Taxes, of course, matter because they are a cash flow. And we want after-tax cash flows in all cases. And inflation, finally, matters as well. So if we have a fairly long time span and inflation is, even if it's only 1 or 2%, we need to account for that to be completely accurate in our analysis. All right, so I already mentioned this already in the prior slide, but depreciation expense. There is no check written for depreciation. You buy an asset and you write a check for that thing. And then you have it through its life and you use it. And then at the end of your use of that asset, if it has any value, you sell it. And that's called salvage value. And again, you want that on an after-tax basis. We'll talk about how to get that because you've got a basis for that asset. And that if you sell it for exactly the basis, then you owe nothing on it. But if you sell it for more than what it's worth on your books, then you have to pay tax on that additional amount. So keep that in mind. All of these things, we have to analyze each one of the items that we are dealing with. Make sure that, if it's a sunk cost, doesn't count. If it's synergies, does count. If it's taxes, does count. If it's depreciation, doesn't count. So be careful as we go through this. It's going to be hard at the beginning, but eventually you'll get the hang of this. All right. I've already mentioned this enough. Sunk costs are not relevant. Just because we've already spent this doesn't mean that it's part of our future analysis. Opportunity costs as well, so I'm going to skip over that. Talked about both erosion and synergies. So we'll flip through that. Here, now we're getting down to brass tacks here. So we want cash flow from operations. All right, so this OCF, operating cash flows, right? All right, and that equals EBIT minus taxes plus depreciation. So let's break that down. Earnings before interest and taxes. All right, that's EBIT. So think of ourselves here on the income statement. We've got an income statement here. We've got revenues. We've got cost of goods sold. Let's drop down here a ways. Down here we have EBIT. And then we have interest. And then we have taxes. So we're about midway down through the income statement. Obviously down at the very bottom we have net income, right? So we're pulling out this number. So this EBIT has taken care of all of the costs up here associated with the actual project, the operation, right? What's missing here is that before we got down here, we have depreciation up here. And remember, we said that that was a non-cash expense. Simple way to deal with that. Simply add it back to EBIT. If there's no cash, that's going to increase my EBIT. All right? So I'm adding it back in there. Now, I also mentioned earlier that taxes do matter. So, since we're up here and we're up here and taxes are down here, we need to subtract off the taxes. We're assuming, of course, that we pay taxes and there is no sort of tax rebate or anything going on, that our net flow in taxes is a cash outflow. So, subtract off the taxes. Now we have taken care of all of the cash flows, and we can properly call that result the operating cash flows, or cash flows from operations. That's just one component. Another component here is capital spending. We've got to buy equipment. We've got to buy vehicles. We might need to buy a plant, some real estate, things of that nature. That's our capital spending. All right. That too is a cash flow. Those usually occur early on in the project, at the very beginning, and oftentimes at what we would call time zero, at the very beginning of the project. Sometimes, we have to replace some of these pieces of equipment. We might have, if we scale up, we might have additional expenses. You account for those when they occur. Another thing that they note here in the text is don't forget the salvage value. That equipment, when we're done with it or when the project is wrapped up, may still have value. The book value may be down to zero, but that doesn't mean that there is no cash value to that asset. You've got a vehicle that you amortize over 5 years, or rather depreciate over 5 years. At the end of 5 years, it's not going to the junkyard, unless the engine's frozen or something. As long as the vehicle is still running and still operational, it has some value. So even if we've fully depreciated that asset down to zero, we still might have some salvage value. Any value above and beyond the basis is going to be taxable, so we have to account for that tax. So that's a cash outflow. The salvage would be a cash inflow. So we're going to have to net that out. And in the example that we're going to work through with this Baldwin company, you'll see how that works in detail. And then another cash flow is net working capital. Remember what net working capital is. NWC. That's current assets minus current liabilities. So anytime we have a new project, not only do we need to have some CapEx or capital spending, this guy up here, which is the equipment, the plant, the property, and so forth, inventory, buying that sort of, cancel that, strike that. Inventory is down here in net working capital. Any fixed assets are going to come under CapEx. Now, net working capital, current assets has what? It's got cash, accounts receivable, inventory, and there may be a couple of other items in there, some sort of accruals, but those are the key items in current assets. Current liabilities, we've got accounts payable, and again, there may be some other accruals in there that matter. But for the most part, it's typically thought of as accounts payable. So it's current assets minus current liabilities. Typically, that figure is a positive figure. Think about it this way. These current assets, this cash, this accounts receivable, this inventory, we've got to have some way of financing that, right? The inventory, they didn't just give us the inventory. We had to pay for it. Where did that money come from? Well, part of it came from accounts payable, because that's sort of like a loan, right? We buy something from another company, and that company says, okay, we'll invoice you for that, and you've got to pay us within 30 days or within X number of weeks or whatever the agreement is. Well, in the meantime, they're basically financing that piece of it for us. But typically, the current liability is less than the current asset. So there's still a piece of it. That piece of it is what we call net working capital that we have to finance with our own money. Whether it's equity or debt doesn't matter at the moment. We'll talk about that too. Okay? Oh, one thing I didn't mention here, and I would be remiss not to, is interest. Why don't we take care of interest? I mean, why isn't that on there? And the answer is that this is an investment decision, not a financing decision yet. All right? We will account for that, and we'll account for that in the weighted average cost of capital. But we don't need to account for it at this point. Okay? All right, I think that's it for this slide. Made a complete mess of it, but I hope that that has been helpful to clarify some of these items. Forgot this slide was in there. It just talks about what I mentioned with interest expense. I knew it was there. I just didn't know it was the next one. All right, let's get on to our example, the Baldwin Company. So the first couple of slides lay out the general parameters of this example, and we'll walk through those slowly. Nice thing about having everything on video here is that if you miss it, you can just scroll back. And so feel free to go back and forth through this. I will be posting these slides as well on Canvas, so you'll have access to the slides. All right, so costs of test marketing already spent, $250,000. What do you think that is? Is that going to be part of our analysis here or not? Right. It's not, because that is a sunk cost. So forget about that. Don't need to worry about it. It's out of our mind. All right, current market value of the proposed factory site, which we already own. What do you think about that one? Is it relevant or not? Yeah, of course, it's one of those opportunity costs, right? Because if we already own it, the opportunity is we could sell it to somebody else for $150,000. But this new project says, hey, we might be able to use it. If this turns out to be a positive NPV, we'll use it. Well, the opportunity cost is that we can't sell it then. So yes, that is a relevant cash flow. All right. Apparently, Baldwin makes bowling balls, so they're going to be buying a bowling ball machine, and that is worth $100,000, and they're going to depreciate it using. So we're using MAKERS. That's the Modified Accelerated Cost Recovery System, and more on that in just a minute. We always like to try to depreciate more quickly early on. Rather than use something like straight line depreciation. That still matters in this case, because even though depreciation itself is not a cash flow, the taxes that we save are a cash flow. So if we can depreciate it earlier, then that saves us taxes, and the present value of that tax shield is more valuable to us. Increase in net working capital, NWC, of $10,000. In other words, that was that. We're looking at NWC equals CA minus CL, just telling us that the current assets are expected to be $10,000 more than the amount of current liabilities with this new project in mind. And then here is some information about the expected production per year over the 5-year life of this project. So the first year we'll produce 5,000 bowling balls, then 8,000, then 12,000, 10,000, and then taper it back down to 6,000 in the 5th year. All right. So this is the part of the setup. Next slide has a bit more information. So what's the price of these bowling balls? Well, the first year it's going to be $20, and then it increases at 2% per year thereafter. All right. The cost is $10 per unit, and that increases at 10% per year thereafter. The annual inflation rate is 5%, and working capital, the initial 10,000 increases with sales, which makes sense. I mean, remember, as we have, we start off with 5,000, but by the time we get into year 3, I believe it is, where we have 12,000, that's going to require more cash, more inventory, we're going to end up with more accounts receivable, and yet our accounts payable are going to go up. They're just not going to go up as fast. All right. So here is a table that enumerates a good bit of this. Let me get out of the way here entirely. All right, so first line here, we have the machine. So it is $100,000 expense. I don't think they told us did they give us the salvage value back here? No, they did not. I believe they give it to us. Where do they give it to us? I don't see it directly related here, but the salvage value actually is going to be 30,000. Note that all these numbers are in thousands. All right. But because we've depreciated most of the value of that machine and already taken deductions to our taxes for that, a good part of that 30,000 is going to be taxable. And we'll look at that detail in just a minute. In fact, we'll look at it when we get to the spreadsheet that I made that follows this problem. So the net after-tax cash flow for salvage is $24,910. All right. Accumulated depreciation. Remember, we're using that MAKERS schedule, and again, this is going to show up. Don't worry about what it is just yet. You'll see a table here shortly, in I think two or three slides down the deck. But the first year that we have that machinery. And by the way, we're depreciating this machine right here for 100,000, right? So the first year is $20,000. The second year we depreciate another 32,000. So this is cumulative. Note, right? Cumulative, accumulated. So that was an extra 32,000 there. And then here is an extra 19.8, or sorry, 19.2. All right, and so on. So this is it comes up to be an accumulated depreciation of 94,240. So we actually end the project before we've fully depreciated the bowling ball machine. All right. Adjusted basis of the machine after depreciation. That's just 100 minus the accumulated depreciation. So 100 minus 20 is 80. 100 minus 52 is 48. 100 minus 94.24 is 576. Okay. Warehouse, 150,000. We're assuming here that we'd be able to, at the end of this project, sell it for exactly the same amount that we're using as an opportunity cost here. Net working capital. We start off with 10, and that stays that way for the first year, but then the second year, it's going to go up a bit. Third year, it goes up a bit more. That's when we reach that 12,000 production level, but then production starts to drop back down. And by the end of this, we're down to zero. We've recouped all of our net working capital. By the way, remember that even though we pay out for net working capital, we can get it back as well. And this next line just shows you the change. So it starts off at the beginning of the year one as an expense. So we load up on inventory. We're going to start seeing our accounts receivable go up. We get a pile of cash ready to go for that year, and so forth. And then it goes up even a bit further here and even a bit further there. So total incremental cash flows, we're just summing several of these rows. So what we're doing here to get this 260, let me change colors here. I'll just clear the markings. The 260 is actually 100,000 plus 150,000, that's 250, plus the 10,000 of additional working capital. So that's our 260,000. All right. The only other items in the intervening year, the accumulated depreciation is not a cash flow per se. So we just have the changes to net working capital. And then finally in this last year, we get back that amount of net working capital. We get back that amount from the warehouse. And then we also get back this after-tax salvage value. And that adds up to $196,130. All right. Next slide is just a duplication, and they're just noting here that this 150 return is that it's now unencumbered. We've created our project, we've made a whole bunch of bowling balls, and now we could do whatever with the warehouse. We could sell it, we could have another, we could iterate this project again, whatever, but for the purposes of this analysis, it doesn't matter. Sales revenue. All right, so $5,000 at $20 per bowling ball gives us $100,000 in sales revenue for year one. Now, we've made some assumptions, simplifying assumptions here. This obviously doesn't all occur at the end of the year. It occurs during the year. So the fact that we're actually getting some of that money back is biasing against this analysis. We're getting some of that money back earlier. So our analysis is biasing against the project. You could split it up into semi-annually if you wanted to, but it shouldn't be too big a deal. Then that $20 per ball increases at 2% per year. So the 8,000 units aren't just 160, they're 163.20. And then another 2% up for the 12,000 units. And then our 10,000 units, still another 2% up. And then finally, the last year of production, we have $129,890 of revenue. All right. Oh, I should note down here they show you the math behind that. So 8,000 times 20 times 1.02 equals 8,000 times that equals 163.2. For year 3, we would simply replace the 8,000 with the 12,000, and we would replace the 1.02 raised to the first with 1.02 raised to the second, and run through that calculation. For the 4th year, replace the 12 with the 10, and it'd be 1.02 to the third, and so forth. All right, operating costs. So this is that $10 per ball raised at 10% per year after. So again, starting in the first year, it's simply $10 times 5,000 or $50,000. Then we increase that by 10%, so it's $11 times 8,000, and we increase that by 10%, and so on. We get 145, 133, and 87.85. Year 2, this down here, 8,000 times 10 times 1.1 raised to the 1 is how we get the 88,000. And so if I wanted to do that for year 3, that'd be 12,000 and still 10, and be 1.10 raised to the second power. That would give us the $145,020. Okay. Here's that maker's schedule. All right, so we have to account for depreciation, and we're going to be using this schedule right here. And so for the first year, we get to depreciate 20%. The second year, another 32%. The third year, 19.2. And then the last 2 years are 11.52. And there's actually, within this particular maker's schedule, there's actually a 6th year. But since our project ends in 5 years, we don't use that 6th year. That's why the basis on our bowling ball machine is not 0 when we go to sell it for salvage. Our cost basis is $100,000. Now, let's say that we had some other items we had to add to that bowling ball machine. There was tax, there was shipping, there was installation. All of that goes onto this cost basis. So we get to capture all of that. And so we can assume that this 100,000 in this case does capture all of that information. So they give you an example here as to how they calculated the year 4. It's simply the 100,000 times the year 4 depreciation amount, which turns out to be 11,520, and that goes up here into our table. And we do similar things for the other 4 years. All right? Okay. Now we're getting somewhere. We've got sales, we've got operating costs, we've got depreciation. Now we can get income before taxes. But wait a minute, Dr. Elliott, I thought you said that that didn't matter. And the answer is, at the end of the day, it doesn't. But we need to know what the taxes are, because those are an actual cash flow. So we still need to work through and figure out what our EBT, right? This is earnings before taxes, which includes depreciation. Even though depreciation is a non-cash expense, we're going to have to bring that back to the party a little bit later. But for the moment, we've got to have it in there because that reduces our tax burden. And that's a good thing. So we come up with a EBT of 30,000 here, and at a 21% tax rate, that means that we owe taxes in the amount of 6.3 thousand. The authors didn't really need to give us net income here, but they did just for grins. But what we really needed was this line up here with the taxes. We're going to carry that along. We're almost there. So now we take the OCF, that operating cash flows, or cash flows from operations. Notice that we just have sales revenue, operating costs, and taxes here. What happened to depreciation? It's gone. Don't need it now. So when we're calculating cash flows, we get rid of all the non-cash deductions. We needed them back here in order to get our tax burden, because those non-cash deductions actually lower our tax bill, right? So add all three of those lines together, and we end up with the operating cash flow in year one of 4370, and year two 6613, year three, year four, year five are given there. Now we go back to our prior table. If you remember back here, we had total cash flow of investments. All right, so that was the CapEx, the capital spending. That's the net working capital, and that's the depreciation, or sorry, that's the salvage. Strike that depreciation. It's the salvage value. So those items are in there. So we're going to bring that line back right here. Okay. Now we're going to sum lines 4, that's right here, and 5, right here. So we've got that $260,000 expense here. And that comes down. That occurred at time 0, so we don't have to discount that. That's already present value. Year 1 is 4370. Year 2 is 6613 minus the additional expense related to increasing our net working capital of 6.3 thousand. So that leaves us with a incremental after-tax cash flow. By the way, that's what that IATCF is there for. Incremental after-tax cash flow of $59,810. We do a similar thing for years 3 and 4. And then finally, in year 5, the big kicker here is that we not only do we have the 35.6, but we also have the return of the warehouse. That was 150. We have the after-tax salvage value of the bowling ball machine. That was another, 24,910, I believe. And then the return of the net working capital, because the project is now ended. So we get our net working capital back. Now, we have all the numbers that we need. What we need to do next is a present value. So NPV is equal to negative 260 plus all of these guys. So we're just taking this last line and we're bringing each one down. Let me just clear this off just to keep things a little neater. We're bringing that down here. MPV equals that. It's a negative, plus. We're bringing this guy down, plus. Bringing this guy. This one, and finally this one. And there's a plus in here, all of these. Notice the exponent. Since this is 2 years out, the end of year 2, we discount that at 10% for 2 years. 3 years out, we discount it at 10% for 3 years, and so on. When we do the math, we end up with a net present value that is positive, which tells us we take the project, and in fact, it's $78,530. Okay? Easy peasy, right? You could plug this into your calculator using uneven cash flows like we looked at in the last chapter. I'm not going to bore you with another example. If you're unsure of how to do that, go back to chapters. I believe we did that in chapter 4. Sorry, it wasn't the last one. It was the one before last. So take a look at that video, and that will show you how to walk through these cash flows, uneven cash flows, using your calculator, or you could do it in a spreadsheet. Now is a good point. Let me open up the spreadsheet here and show you all of this. I've got it all laid out in the spreadsheet as well. And in the spreadsheet, the nice part about that is that I've got the formulas embedded in there. So you can see exactly what's happening. I'll show you how you calculate the after-tax salvage value, as well as all of the other items, the depreciation, the figuring out what the tax bill is, and so on and so forth. So let me switch over to the spreadsheet and we'll walk through that. Okay, so here is my spreadsheet. And again, I'm sharing this with you on Canvas. So if you'd like to open up this spreadsheet on your own computer and kind of follow along, please do that now. You can just pause the video and I'll keep rolling while you get that open. Pardon me. So up here in the green area, let me just zoom in a little bit here. I've got some of the basic parameters that we were given on those first 2 slides. So for instance, we've got the cost of the facility, that is the warehouse, that's $150. Cost of the bowling ball machine, $100,000. The salvage value is estimated at $30,000. Initial change in net working capital, $10,000, and then price per unit and cost per unit at 20 and 10 respectively. And then the corporate tax rate of 21%. And we're assuming a cost of capital here of 10%. We're really going to dig into that cost of capital piece in chapter 7. So look forward to that. But for right now, let's just assume that we know what it is, and that's going to be what we'll use to discount all of our cash flows that we've generated here. All right. Now we can come down here a little bit. And I've tried to divide these up into similar to what you saw on the slides. So the first set of data here is still pretty much informational out of the setup. What I did was, for instance, units sold. So I've got 5,000 here, 8,000, 12, 10, and 6, right? Down here, I said, well, 2% is our annual price increase. And in any given year, what does that actually amount to? Well, in year 2, first we're going to start at $20, right, in year 1. And then in year 2, that goes up by 2%. So that's just a straight 2%. But notice the way I've coded this. Let me zoom in a little bit here. Here's the formula that I used. So I took B1 plus B13. B13 is this 2% annual price increase. And I raised it to this exponent here. So that exponent is D11 minus 1. So in this case, D11 for year 2, D11 is 2, minus 1 is 1. So I'm only doing this, I'm only increasing by 2% for that second year. So I know it looks weird, but trust me, when we go out to years 3, 4, and 5, all I have to do is copy to the right, and I don't have to change anything. So yes, I know D11 minus 1 is equal to 1, and I don't need that exponent here, theoretically. But if I want to write the equation once and then just copy right, I'm going to write it the way I need it for years for 3, 4, and 5 as well. So get in that sort of habit too when you're working in a spreadsheet. It's always a good thing to stay on top of that. And even if you can make it simpler for a given year, making it the same across all years will make it easier to figure out what you did. If you go back to this months later or weeks later and have forgotten, what did I do here? Why did I do it this way? Or if you find any errors, hopefully it'll ease that. And then we're also subtracting off that, or subtract that final minus 1 is outside of the exponent, right? So all we're doing there is subtracting off of that that first 1. We took 1 plus 0.02 raised to the first power. Now we have to subtract off that 1, and we're going to end up with just the 2% right there in cell D13. All right. Let's zoom back out real quickly here. I don't want to give you get you seasick with all of that, but and I did the same thing here for this cell. Now that's rounded off, right? So there's a decimal to the right of that 0, so it's 4.0 something. It's a little more than 4%. And you'll notice that shows up here, the second year that we increased the 2%, or that year 4 rather. So it's actually 6.1. So we've increased it by 2% in year 2, another 2% in year 3, which is actually a little over 4% total. We've increased that again by a little bit more. And then this final year actually ends up being 8.2%. All right, so the reason that I've done it this way, this 2%, 4%, 6.1, and 8.2, is to make this spreadsheet as flexible as possible, right? I could have just hard-coded everything in there, but then if I had any mistakes or I needed to make any changes, I'd have to go back through each and every year and make sure I fixed it. So whenever I'm building a spreadsheet, I always build in as much flexibility as possible, so that, let's say for instance, somebody says, no, actually the price for the bowling balls is actually going to be $22. I can update that simply by changing B6 from 20 to 22, and everything else updates. I don't have to touch anything else in the spreadsheet. So get in that habit. When you're building a spreadsheet, make sure that you build it with as much flexibility in it as you possibly can. I did the same exact thing here for the cost increases. Notice it goes 10, 21, 33.1, 46.4. So if somebody tells me, you know what, actually the cost is 11, not 10. Okay, easy. Change that cell B7 to 11. Everything in the spreadsheet, all of this over here, don't know which, the camera's reversed, so all of this over here changes automatically. I don't have to think about it. I don't have to go in and find that buried formula or where I hard-coded something. Let's see here. Makers, I've just plugged that in. I've plugged in the machine cost. And again, even that is a cell reference. So I'm referencing that data up in the green. But I did want to bring it down there and kind of keep it in this spot. I also did the salvage costs. Now, let me show you how that works out with the salvage cost here, because this formula again is embedded in there so that if maybe they say, oh, wait a minute, we misestimated the salvage value, it's only 25,000. Okay, not a problem. All I have to do is go up here and change that 30 to 25, and everything else takes care of itself. So let's, since I did promise you we'd talk about this in more detail, let's see how that actually works out. So I've clicked on the formula, so it highlights all of the cells that are part of this formula. I've got salvage of the equipment up here in B4. I have the corporate tax rate in B8. I'm also going down here to G19, adjusted basis after depreciation. So think about that as it's what the books say it's worth. The books say it's worth $5,760. That's what we've depreciated it to. If we were to sell that for $5,760 exactly, we would get exactly $5,760, period. End of story. No taxes. That is after tax, because there would be no taxes due on that, because it's the basis, it's the book value. We're just getting back what we say on our books it's worth. However, in this case, we're actually getting more than what the books say it's worth, or what we've been allowed to depreciate it down to. We're getting an extra nearly $25,000 if we sell it for $30,000. So that entire amount above the $5,760 is taxable. Okay, so that's why you also notice that I'm referencing B8, which is the corporate tax rate. So let's walk through the formula. So I'll zoom in. Let's see, I don't want to zoom in quite so far. Let's leave it at that. All right, notice up here, I've got B4 minus, and then that thing in parentheses, times B8. Okay, B4 is simply the price of the machine, or the salvage value of the machinery. So that's 30,000, right? Now, in the parentheses, I have, again, referenced B4, which is 30,000, minus G19. Remember what G19 was? Yeah, G19 was right down here, 5,760. That's my basis. That's the value on the books. Anything above that is taxable, right? So what I've done here is I've found B4 minus that basis. That tells me the amount that's going to be taxed. And then I multiply that simply by the tax rate, B8, that 21%. I subtract off that tax due, and that becomes my net salvage value. Okay? And again, the beauty of the video here is if that didn't make sense the first time, you can go back and look at it again. Right? By the way, probably shouldn't tell you this. I don't know how many of you use YouTube a lot, but you do realize that you can actually change the speed on any YouTube video, this one included. So you can start at normal and leave it by default it goes to normal. But if you want to rip through this a little quicker and this all makes sense to you and you just want to make sure you don't miss anything, put it at 1 1/4 speed. The nice thing about 1 1/4 speed is that when it speeds things up, it doesn't turn you into Mickey Mouse. It adjusts the tone of the audio, so it doesn't sound all squeaky, but it does move a little bit faster, and so you get done in a little bit less time watching it. But only do that if you really feel confident about this. Otherwise, leave it at normal speed. All right, so that is our after-tax salvage value, that $24.91. And then I've got down here, I've got the maker schedule. I've just hard-coded that maker schedule into this. I could have referenced it elsewhere and even make that flexible, but in this case, I didn't think that was necessary. Then these blue lines show me all of the investment cash flows, right? And I have to deal with depreciation here a little bit. I need to figure out what that is so that I can get my basis and so forth. So I've just plugged in the depreciation using the maker's schedule. Notice that that too is a formula. So I'm taking 20% of 100,000 and I'm taking the negative of that because I have the 100,000 as a negative. That's a cash outflow. So it's negative C16, which is the maker's schedule, times B15. Make sense? And I do the same thing here with this one, except that it's D16 and B15, and so on down the line as we go. Okay? Accumulative depreciation, again, is simply adding up as we go, and then I subtract that from my my cost, my initial cost, and I have my adjusted basis at each point in time. It's this one that's really important for figuring out what our after-tax salvage value is. Opportunity costs, that's the warehouse. And I've got that plugged in here. Actually, I see I should have coded that as B2, and I didn't. I messed up. I'll fix that before I post this. And likewise here, I hard-coded that in. I should have referenced up here. I'll fix it. All right, net working capital, we increased by $10. Initially, we hold that for the first year, and then we increase a little bit more, and we increase a little bit more, and then we start to get it back, and then we get it all back at the end. So that becomes 0. Change in net working capital, that's the one that I really need, and that's the one that you'll see later on showing up in our down here when we sum up our investment cash flows. Okay, so here this line 23 is actually transferred down to line 32 as well. Now that one I did do properly. I referenced up to line 23, which is as it should be. Notice here too that I'm just using sums. I prefer to do that or relative to, say, doing just, say, B15 plus B20 plus B22. I like using that sum function. It's a little bit cleaner. Even if I'm not doing a range, I can do individual cells by just putting a comma in between them. So another pro tip on Excel here. Now we have our income and costs down in the salmon colored block here. So again, 100,000, and again that is a cell reference. So we've got 5,000 up here in C12 times the price per unit on B6 of $20. So if I change that sales figure, number of units, or if I change the price per unit, everything updates still. So I don't have to monkey around down here in the income and expense section. All I have to do is change it up here. Oops, where'd it go? There we go, up there, and this line. All right. And I do the same thing for the other 4 years for the sales. Operating expenses, same story. Oh, by the way, let me mention on the sales, this first one is just 5,000 times the price up in the green box, $20. The next one and all subsequent revenues are that same starting price of $20 increased by 2% per year. So notice here how I'm referencing that cell D12 and D13 as well as B6 to come up with the revenue for year 2. And I do the exact same thing. All I have to do is copy that formula over to the right, and years 3, 4, and 5 are done, taken care of. So it speeds up the work on building this spreadsheet. I've done the same thing for the expenses. That one I actually did the first year just like I do years 2, 3, 4, and 5. Even though there is no cost increase for that first year. I should have done that with their sales revenue too. I'll fix that one too for you before I upload the spreadsheet. All right. Depreciation, we've got to have it in there, even though it's not going to stay. We've got to have it in there so we can calculate our taxes, right? So depreciation, how did I do that? Well, I just referenced the cell C17, which is right up here. Likewise, I reference cell D17, E17, and so on to get the depreciation. Now I have EBT, earnings before taxes, and now I can figure out my tax. And by the way, that's just simply a sum. And that's that range, those 3 rows above that. Okay. All right. Now I can figure out my taxes. And again, keep it as a formula. Don't hard code anything in. So that is the EBT in cell C, what is that, 28? And the corporate tax rate in cell B8. So if I happen to change the corporate tax rate, or if I need to change the EBT, it's easily done in my taxes update correctly. And I've done the same thing for years 2, 3, and 4, and 5 on the taxes. And I kept this net income in here simply because your authors did as well, but that really could be left out. That's unnecessary for anything. But it does tell us what we'd actually see on the income statement if we were looking at it for this project. Now we have our operating cash flows. And again, that's a formula. So it's simply the revenue minus the operating expenses minus the taxes. And since I've taken the form of using sums, I've made sure that my cash outflows are negatives. So when I sum all of those up, the revenues plus the cash outflows, pardon me, I end up with the correct value. So there's my operating cash flows. Investments cash flows, I just bring those down from up above, from row 23. I just wanted them in the same place so that we could see them more easily together. Incremental after-tax cash flows. So there what I'm doing is I'm summing together rows 31 and 32. Notice that. And I continue doing that with the rest of these guys. And then I'm going to do a present value down here. And again, it's a formula. And that formula happens to reference not only the incremental after-tax cash flow, but it also goes up here and it says, oh, well, that occurred at the end of year 1. And my cost of capital up here in B9 is 10%. So, and I discount that back for 1 year. I do a similar thing for this, except D11, D11 is 2 years. So I'm discounting that cash flow back for 2 years. So my $59,810 cash flow in year 2 has a present value of $49,430. Likewise for years 3, 4, and 5. And then finally, all I have to do is that sum. In this case, it's a range because they're all contiguous. And I just sum up the expense plus all of the positive operating cash flows net of any other additional investments for net working capital, and then the return of the salvage value of the machinery, return of the opportunity costs for the warehouse, and yeah, I already said net working capital, or did I? I don't think I did. All right, so all of that goes back, and I get the $78,530. So I hope that having it in a spreadsheet where all of the formulas relate back to the initial data is going to be helpful to you in terms of figuring out how to do this. And you can play around with these numbers too. You could even play around with, well, what sort of revenue, if my revenue were, say, only 15 instead of 20, would I still have a positive NPV project? Well, let's see. The answer is, oops, no. I go negative. So I'd really like to know, what's the sensitivity of the market to the price of the bowling balls I'm going to be producing? $20 seems kind of cheap for a bowling ball, though, doesn't it? I haven't bought any bowling balls lately. I usually rent, but boy, can't imagine they're $20 these days. I could even play around with, well, what number would actually give me a NPV of about 0? Let's see what 17. Yeah, 17's pretty close. I'm just a shade above 0 here. So I could drop my price by as much as $3. I'm still doing that 2%, right? Every year after year 1. But I could have a starting price as low as $17 and still have this project go. And again, I could do similar sorts of analysis with the cost structure as well. I can take a look. What if costs went up to, say, $13? Would I still have a positive NPV project? No, I wouldn't. So I better be pretty careful about that cost. Make sure that I'm right on the money. I think 12 might be close to break. Yeah, 12 puts us over. So as long as my costs don't go much over 12, I still have a project. That brings up another point that wasn't entirely discussed in any detail in your book, and that is that you need to, well, I take that back. They did mention it, but you need to do some sensitivity analysis. Sensitivity analysis is really where it's at. You come up with a single number, and it's inevitably going to be wrong. The odds are against you. If I tell you that we're going to make $1 million, what if we only make $950,000? I'm wrong. What if we made 1,100,000? I'd still be wrong. But if I give you a range, if I say that we might make between 900,000 and $1.2 million, then I've got a much better chance of being correct. So there are some ways you can do this. You could do something as simple as what I just demonstrated here by changing one number up or down and looking at your net present value. But an even better way to do this is to use something called a Monte Carlo simulation. Let me get back to a slide that I can write on here. I'm just going to use this for the blackboard. Monte Carlo simulation. Yes, it's from the place in France, Monte Carlo. Actually, it's not in France, but it's near France, on the Mediterranean. What you do with a Monte Carlo simulation is you change some of the inputs to your model, and then you look at what the result is. And you do that a whole bunch of times. So a fancier way of saying that is I parameterize the inputs, I run the Monte Carlo simulation on the model, and I get a distribution of outputs. Let me put that into a little more concrete terms for you. Let's say that I expect price to range between $18 and $22, and it's going to more or less follow a normal distribution. I know it doesn't look like a normal distribution, but this isn't art school, folks. And let's say that it costs, I expect to run between $8 and $12, and I expect those to follow a uniform distribution, so equally likely. And then I run a Monte Carlo simulation on the spreadsheet that we were just looking at. And my output figure is that NPV. And I want to run, say, 10,000 iterations. So I'm going to do 10,000 iterations. So what I'm doing with each of those is I am going to go to this distribution and I'm going to pick randomly a number out of that distribution. Now, because there's more weight between here and here than there is out here or back here, it's more likely I'm going to pick a figure between, say, like 19 and 21. Here, it's equally likely across 8 to 12. But so I'm going to pick one number out of this distribution. I'm going to pick another number at random out of this distribution. Then I'm going to plug those into my spreadsheet. I'm going to look at what the NPV is, and I'm going to record that. Okay? That's iteration 1. Now I go back to these distributions, and I pick another number at random. And by the way, I put the first number back in, so it's picking at random with replacement. I do the same thing for this distribution. I pick a different, I pick it at random, and usually it's going to be a different number, right? And I plug that into my spreadsheet, and I go down to the bottom and I look at the net present value, and I record that. That's iteration 2. I do that 9,998 more times, and I record every one of those NPVs. And what I find is that I get something that looks like this. Oops, I ran off the edge of my screen here. Let me erase that, start over. I get a distribution that looks about like this. And 0 is here, and this is all positive. And this is negative. Oops. All right. So now I can actually say, I can actually have my my distribution here, and I can tell you that 90% of the distribution lies to the right of 0. 10% of it lies to the left. So I can say that I'm 90% confident that we should take this project. And 9 times out of 10, I'd be correct. So that's much better, much more robust means of giving information to your boss when you're evaluating a project. Because instead of giving them a single number, or even, here's a range, but, it could be that we're outside that range, and I don't know. That's all very subjective and intangible. But if I'm actually doing something like a Monte Carlo simulation, that is very tangible. Now, it's not without problems. I'll grant you that. For instance, how do I know that this sales is a normal distribution? How do I know that the cost structure is a uniform distribution? I don't. I would have to do some research on that. To make sure that I'm correct. And how do I know what the variance of those distributions is? Well, I'd have to go out and do a little bit of legwork and research and figure that out. I'd look at my competitors as much as I could. I'd try to think about inflation, things of that nature that are going to possibly impact our estimates. So Monte Carlo simulations, you might think, well, gee, I don't want to do 10,000 of those by hand. And I agree, you don't want to, because there are a couple of really cool plugins to Excel. One of them is called At Risk, and the other one is called Crystal Ball. I believe I'm spelling that correctly. Both of those are plugins to Excel, and they make this Monte Carlo simulation a point-and-click exercise. They make it so easy that everybody should be doing this. And I will get a trial version of that. You can download it. You can get like a 2-week kind of disabled version just to play around with. I'd recommend if you're at all serious about finance, try that out. Check it out. It's very cool software. One of these is at Palisades. Let's see here. Palisades. Software. There we go. I forget if it's Crystal Ball or At Risk. They are now Lumavero. And yeah, it's At Risk right here. And they're giving you a little bit of a live demonstration here. This is what some of the output looks like, actually. As the Monte Carlo simulation adds iterations to it, you can actually watch in real time, watch that distribution evolve, which is kind of cool. So that's At Risk. The other one is Crystal Ball. They both do the same thing, more or less, but they're pretty cool to check out. So make sure you take advantage of that. And let's go back to the slides here. We've already done the Baldwin Company. All right, a couple of things to close out the chapter here before we wrap up the video. So a couple of different ways of approaching operating cash flows. You can do what's called the top-down approach, or you can do the bottom-up approach. The top-down approach says, well, let's start at the top of the income statement. Revenue, sales, right? And then subtract out all of the cash expenses, only cash expenses, right? Subtract those out. Subtract out the taxes. Don't worry about interest, but do subtract out the taxes. And then the bottom-up approach says, well, let's start down here at net income and add back the non-cash expenses. Well, we've got this. By the way, these examples that the authors give you, they assume no interest is in the income statement. So if there is interest, you have to back that out, right? And you want to back out the tax savings on that too. Because when we do deal with the financing piece of this, that is bonds and equity, we're going to do all of that on an after-tax basis. All right. And then there's finally the tax shield approach. The tax shield approach has some interesting characteristics to it in that, we're looking at 1 minus the tax rate. That's the after-tax of the sales minus the cash costs. And then we're going to add back the tax savings due to depreciation. Oops, I'm in the way of that one. Let me move on out here. Hang on. There we go. That shows us how much depreciation is bringing to the table, because it's the amount of the depreciation times the corporate tax rate. That's how much tax we're saving. It's how much tax we didn't have to pay out because of depreciation. So we're adding that back in. So these three techniques, they all end with exactly the same operating cash flow. If they don't, you've done something wrong. Or maybe you've got interest in there and you haven't accounted for that, right? A couple of other things here before we close up, and I'll come back in. Cost-cutting proposals, how do you deal with that? Because you don't have revenue, all you're doing is cutting costs. Setting a bid price. So suppose you're working for you're bidding on a government project, and you've got to pick a bid price. And then finally, the third item that they wrap the chapter up with is figuring out how do I deal with comparing two projects that have different lengths of lives with them. So in terms of cost savings will increase pre-tax income. Right. Because if I reduce my cash costs, that increases my EBT. Why are we doing this? Oh, because the taxes are going to go up a little bit, but I'm going to save more on the reduction in the cash expenses. So, what do I do? Well, I'm kind of balancing these things. While the cost savings increase pre-tax income, depreciation will reduce our tax liability. The question that we have to answer is, does the present value of the cash flows associated with the cost savings exceed the cost? If the answer is yes, then we go on. So relatively simple, but don't forget, cost savings are not just savings. They actually do cause us to pay more in taxes. And so we've got to balance those guys. Setting a bid price, well, really, I don't even know why they mention this, other than I guess there are a lot of people who don't use capital budgeting techniques when they're talking about a bid. But really, ultimately, all we're doing here is looking for another NPV. But in this case, since we're assuming it's a competitive bid, and we'd like to get the bid, but we don't want to get the bid if we have to take on a negative NPV project. At least by going through the capital budgeting exercise like we just did, we can figure out what's the least we could charge. In fact, we could go back to that spreadsheet and we could actually look at that and figure out what's the least we could charge. Let's say the government was buying bowling balls from Baldwin, and we're trying to bid that out, and we'd like to figure out, well, what's the least we could spend on that? So we're going to first, let me change this back to 10 for the cost. And we know that we ended up with 78,530 MPV. So what I'm going to do is I'm going to reduce that 20 down to 18. And that's going to drop it down. So we could charge as little as 18, but if we really want that bid, let's bring it all the way down. Let's try 1750. Oh, we can go lower than that. 17. No, we can't go low. Oh, I just changed the wrong thing. Sorry, my bad. Let's go to 17. Oops. Yeah, 17's about the lowest I could go and still have almost a zero, 2,810. I could probably drop it down to, if I really wanted to get competitive, I could say 1690. Yeah, that's about it. It's my bottom dollar. I bid 1690 to produce bowling balls for the government. All right, but that's what that's about. That's the idea of using this capital budgeting technique to figure out the best bid that you can place while still not running into the negative NPV project realm. There's a tendency to do that because if you want it's called the winner's curse, right? If you get the bid, if you win the bid, you're always going, oh God, did I charge enough? Maybe I didn't because everybody else was above me. I got the bid. Eek. What did they see that I missed? Right? That's the winner's curse. But here you can at least reduce the probability of that occurring. At least if you don't have any mistakes in your spreadsheet here. All right. Let's go back to this and get back to chapter 6. Okay, so when it comes to unequal lives of two mutually exclusive projects, we have another problem, right? Because if we have one project, like this example, one project lasts 10 years, the other project only lasts 5 years, they're not directly comparable when we do this. So this particular example, I think, is a good one. This is just the trying to minimize the cost, right? There is no revenue. So we have this Cadillac cleaner that costs $4,000 and has annual operating costs of $100 every year for 10 years. And then we have Cheapskate cleaner, which costs $1,000. It's a quarter of the price, but annual operating expenses are $500 per year. A lot of people, by the way, while we're looking at these two things, a lot of people make this mistake on buying appliances for their homes. So when you're looking at the cost of, say, a Sub-Zero refrigerator freezer compared to a really fancy high-end Samsung, yeah, the Sub-Zero is going to cost more. There's no question about it. But how long is it going to last? And what are the expenses going to be? And even as an owner of a Sub-Zero, we've had one for probably, I don't know, 15 years now. I'll tell you, you lose less food in it too. So there's even that. And they're very efficient. So a lot of people look at that cost of a Sub-Zero and go, whoa, no, I'm not going to do it. But what you don't realize is that those things will last decades and decades. Where's that Samsung? It'll last a good 10 years, maybe 15. You're really pushing your luck much past that. And they're less efficient and losing more food, potentially more spoilage. Maybe you get sick because you ate something that went bad. Anyway, you get the idea. This is the same sort of situation here. This Cadillac cleaner costs more, but the operating costs are lower than the Cheapskate cleaner, which costs much less, but has 5 times the operating expenses. So how do we make this decision? Well, the next thing we need to know is what's the discount rate. In this case, it's 10%. So we're going to just figure this out using our handy-dandy uneven cash flows, because it's not that these cash flows are uneven. It's just that there are a bunch of them that they're the same. And so you could actually do this in the regular 5-key NI, PV, FV payment. You could use this as a kind of a payment, but trouble with that is that both of these are cash outflows, so that's not going to work. So you got to do it in this uneven cash flow function on your calculator here. So you're going to be up here on that cash flow button right there. Okay. All right, so we plug in for our initial cash flow outflow of 4,000, our operating expenses of 100 per year for 10 years. Notice that's F1 there. Remember, we were just using a 1 for the other problems we worked in earlier chapters. Here we're going to use the 10 because that's the same cash flow for 10 years. We're using a 10 here because that is the discount rate. That's our I. And then we're going to compute the NPV, which gives us a present value of our costs of $4,614.46. We go over to the Cheapskate air cleaner, and its initial cost is $1,000, operating expenses of $500, 5 years, and then still 10%. Compute the NPV oh, this thing is a lot cheaper. $28.95. But you can already kind of see where this is going, can't you? Right? Because this is half the life of this. Now, this isn't the proper way to do this, but I could just do a real quick back of the envelope and notice that if I doubled that, it's going to be more than that. Now, what I could do is I could say, well, I've got this 10-year life, and that one is 46.14. Then I've got a 5-year, which is 28.95. And then I've got another 28.95 out here. And what I could do is discount that 28.95 back 5 years, add it to this figure at 10%. And then I would get pretty close to it. But there's a simpler way to do that. This one is pretty obvious because it's a very simple example. But a better way to do this is to use what's called the equivalent annual cost, EAC. All right, so I just mentioned this slide already. It overlooks the fact that the Cadillac cleaner lasts twice as long. All right, so how does the EAC work? Well, what we're doing with that is we're getting a value of the level payment annuity that has the same present value as our original set of cash flows. Ooh, what's that mean? Well, remember, look at our cash flows here. Yeah, this is all messy. Let's go down here. We've got 4,000 initial outlay, and then 100, 100, 100, 100. So we got times 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, and finally 10. All right. The last 10 are even cash flows, but that first one is a pretty big one. So what we're going to try to do is we're going to try to make all of these cash flows the same number. But what we're going for is that negative 4,600 something. What I'm trying for is that 4,600. I want a present value of that. But I want each of these cash flows to be identical, not just the last 10. That's all I'm doing here. That's all that this EAC does. What was that? Yeah, it was 46.14. So when I do that, I come up with a equivalent annual cost for the Cadillac cleaner of $750.98. That's every year. $750.98. The cheapskate cleaner turns out to be $763.80. So about a little under $13 difference per year. Is that worth savings? Yeah, I mean, I would argue it is, as long as my inputs are reasonable. Yeah, why not take it? So how do you do this? Here's the example. So I have this initial cash flow. I have all of these other cash flows, and I get my NPV out of that. Now I shift over here, and I say, let me take that NPV, well, PV really. Let me take that PV and plug it in here, that negative 4614. I've got 10 years. I'm going to use that discount rate of 10%, and then I'm going to assume a 0 future value, and I solve for the payment. That's the annual payment, and that turns out to be $750.98. Plug it into your own calculators and give that a try. Make sure that you understand that. With the cheapskate, we do exactly the same thing. The difference is that this is our present value, and so we put that in over here as a PV, zero out the future value, plug in 5 years, 10%, and solve for a payment, an annual payment of $763.80. There you go. All right. Okay. Inflation and capital budgeting. It's an important piece of this. Think about that Fisher equation, that Fisher relation. The Fisher relation says 1 plus the nominal rate is equal to 1 plus the real rate times 1 plus the inflation rate. So, yeah, inflation is going to impact us not only in terms of price of goods, it'll help us out on the revenue side, but it'll hurt us on the cost side. And when we're borrowing, it factors into the cost of borrowing as well. So, something to keep in mind. We're just living through a period of inflation that we haven't seen for like about 40 some years. And so you all are getting a nice dose of that. Luckily, unlike other periods of time, it has not caused, or rather, the remedy of decreasing inflation has not caused the economy to crash yet. Knock on wood. But anyway, you get the idea. It is an important part of the process, and we have to make a decision. We can either deal with all real cash flows discounted at real rates, or we can deal with nominal cash flows discounted at nominal rates. But don't mix that up. Don't take nominal cash flows and use real rates, or vice versa. You will end up with a problem and a wrong answer. And that wraps up this chapter. So if you do have any questions, just a reminder, take a look at the discussion forum and post your questions there. I'll be watching. Others of you that see a question, if you have a similar question, maybe chime in. But if you know an answer to the question, or you think you do, right? I mean, you don't have to be right. Just give it a shot, and I'll take a look and I'll jump in there too and give you my 2 cents. All right, so that's it for the day, and I will see you next time, and we'll be talking about Chapter 7. Thanks very much. Bye-bye.